Hey everybody, welcome to Mortgage Today for Thursday, January 2nd, 2025. And oh, what a day it was. UMBS opened up 15 basis points this morning to celebrate the new year. Stock futures were up 45 points. Bonds were steadily stronger overnight, both in Asia and Europe. 10-year yields at MBS had both fully erased Tuesday's losses within the first 30 minutes of domestic trading. That's when jobless claims data came out. It was only slightly stronger than expected, but was enough to cause a bounce back towards slightly milder gains. Jobless claims came in at 221,000 versus 222,000 forecast. It was 219 previously. Continuing claims came in at 1.844 million versus 1.89 million forecast. It was 1.910 previously. S&P Global Manufacturing PMI came in at 49.4 versus 48.3 forecast, so higher than expected. It was 49.7 previously. For sale housing inventory rose 0.5% month over month and 12.1% year over year in November, according to Redfin. That said, much of this inventory has been hanging around for a while as sellers refuse to cut prices. Over half of the inventory has been on market without a contract for over 60 days. This phenomenon is most concentrated in Florida and Texas, where there have been a lot of building. Rising HOA fees and insurance costs are making people rethink moving to Florida. Something to watch in 2025, the Chinese government bond yield. As the real estate bust settles in, Chinese government bond yields are collapsing as investors rush to put money in safe assets. China has a massive debt problem similar to the U.S. in 1929 and Japan in 1989. This will send deflationary pulse through the world and should help to A, push down yields globally, and B, push down commodity inflation. In the 1980s, the Japanese were voracious buyers of U.S. real estate, and for the past 10 years, Chinese investors have been big buyers of the U.S. and Canada. Chinese property investors may be forced to liquidate U.S. holdings in order to cover debts. Since domestic demand in China is collapsing, the country should continue to run trade deficits globally, which means increased demand for sovereign debt, pushing global yields lower. Bonds began the day in moderately stronger territory before losing ground after the jobless claims data. Selling stalled shortly after bonds hit negative territory and settled sideways to slightly stronger in the afternoon. While that constitutes a reasonable amount of volatility, as did the previous session on Tuesday, the magnitude of the movements has been fairly mild. All in all, it is an uneventful start to the new year and a typical boring winter holiday trading environment. If there's one thing to focus on, it's that the trading levels are right in line with the day after the Fed day. If there are two things, the second would be the yields that are a bit lower than they were at the end of last week. So UMBS closed the day down 2 basis points net, which is down 17 basis points on the day total at 98.62. So at 98.62, we're well below all the trend lines, though you can kind of see here some sort of a retracement line right here at 98.9. We've come up and flirted with it a couple of times, tested it, but failed. Except for the one time that we failed way below it and have stayed below it. So hopefully we get some bad news to get better rates.